Welcome to the Compounders Podcast, where we explore the anatomy of public company wealth creation stories. On this show, we invite you to be a fly on the wall for the actual conversations professional investors have with public company CEOs. I'm your host, Ben Claremont, a partner and portfolio manager at Cove Street Capital. In these conversations, I interview senior executives by posing the exact questions I ask as part of Cove Street's diligence process. Whether you are a professional investor, founder, or someone who is simply interested in business, we think this podcast has something for you. This season of Compounders, the Anatomy of a Multibagger, is sponsored by Tegus. Tegus is an innovative and disruptive company that is changing the way professional investors work. For more information, please visit their site at tegus.co.
All opinions expressed by your hosts and the podcast guests are solely their own opinion and do not reflect the opinion of Cove Street Capital or any affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The hosts and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable.
Our guest on the show today is Ramesh Srinivasan, the CEO of Agilysys. Agilysys is a $900 million market cap company that provides software and hardware products and services to the hospitality industry. Ramesh became CEO back in 2017 after a somewhat rocky turnaround attempt by a prior management team. Agilysys was starting to generate higher gross margins and revenue growth before the COVID outbreak impacted its trajectory, starting in the company's fiscal year 2021. Given the recent challenges and with everything going on in the hospitality industry, I was eager to talk with Ramesh about the organic growth path he sees for the company in upcoming years, how the company manages the desire to grow with the need to generate operating profits, the ways in which Agilysys helped its customers respond to the COVID-related issues, his thoughts on M&A and expanding the company's presence outside the US, and the benefits and challenges associated with rolling out cloud-native software as a service products. For full disclosure, Cove Street is not an Agilysys shareholder. And without any further ado, here's my conversation with Agilysys CEO, Ramesh Srinivasan. As always, we will start at a pivotal moment in the company's history. Let's go back to 2017 when you became CEO. From my understanding, you took over after a somewhat rocky turnaround attempt by a prior management team. What was it that drew you to the company, and what did you think needed to be done to change the trajectory of Agilysys?
Yes, Ben, good morning. Yes, January 2017, I actually joined Agilysys on the very first day of a working day of January 2017. And yes, there were multiple major issues that the company was grappling with. One of them was, the biggest of them all was the product issue. So we had a set of products that Agilysys over a period of time in the past, before 2012, 2013, when it decided it's only going to focus on hospitality software solutions. Before that, they had acquired a bunch of products that were still of old technology. And as of Jan 2017, was still constituting well more than 90% of the revenue. Now, starting 2012, 2013, this company had started developing a couple of products that were a lot more modern technology into which a lot of money was poured. That's where all the money was going. And those products didn't have enough feature sets to be competitive enough in the market. So here you had two products that had used up a lot of the money, that didn't have enough features. And you had a whole set of products that customers were depending on that were sort of not taken care of, let's say, for 4 or 5 years. So the situation product-wise was a set of products that you were dependent on revenue that were very old technology, and a couple of products that had the technology but didn't have the feature sets. And the other issue was customers were quite unhappy that time because the products they had invested in were not moving forward for the last few years. Along with that, with the customer dissatisfaction levels, the company was also losing cash, about 13 to 15 million cash a year. So it was like a multiple variable equation, and all those variables were not going well. Now, what attracted me to the job is that, number one, turnarounds haven't phased me before. I've been through 1 or 2 turnarounds in public enterprise software companies that turned out to be extraordinarily successful. So I had the confidence that we could handle this. And when I analyzed it, I thought all the problems or all the challenges with this company were all internal. You could control them. We had control over them. Like there was no government regulation issue. There was no environmental issue. There was nothing like that. This was all man-made that we could handle inside. Entirely hospitality focused. And remember, that time I didn't know the meaning of two words, pandemic and COVID. If you had told me January 2017 pandemic, I had no idea. So I thought we could control it and we could fix this if we do the right things, like had happened in a couple of companies before. So I was confident of turning it around. The TAM was huge. The total addressable market was in billions, while this was more like a 125 annual revenue company. So that was a huge opportunity in front of it. And the competition was good, not great. Many big competitors who did 1,000 things also did hospitality. Many small competitors were struggling to scale. So I thought this was a controllable opportunity that if you do the right things, you could move this company forward.
And to dig in a little bit on that, so that sounds like a really difficult equation to solve, and it seems like you had to invest in some things and not invest in others. So what has, let's go from 2017 to pre-COVID. What did you do to try to solve that equation?
Yeah, so you start peeling the onion one by one, and the biggest layer of the issue was R&D. So you had a bunch of products that customers really liked, that were rich in feature sets and that were rich in business functionality. You had a couple of products that were good technology but didn't have many of the features. So it was an R&D issue to start with. And in order to resolve that, the first thing you needed to, and it was also not a financially healthy company. So what you needed to do was reduce the cost of R&D per unit of output. So that was the very first objective. And in a way, it simplified itself because that was the problem glaring in front of your face. I mean, you didn't require consultants to come in and figure that out. It was right in front of your face that unless you solve the product problem, this company was not going anywhere. And you had to solve it while simultaneously fixing the financial issues with the company as well. So reducing the cost of per unit of output of R&D was the first focus. Now, luckily, in a previous couple of jobs where I had, been fairly successful before, we knew how to handle a captive offshore development center, which this company did not have. So starting the India Development Center was quite crucial. So we built a good combination of US R&D and, India-based R&D that started modernizing the core products, that started adding features to those two products. And also, before COVID or during COVID, created 17 new modules, software modules, that made us an end-to-end hospitality software provider, all of modern technology. So it was R&D that we had to fix first, and we put all our eggs in that basket for about 4 or 5 years.
And where would you say you are on that journey? I mean, have you gotten to where you want to be? Because I see that you started to spend a lot more on R&D. You've tripled the team already. I mean, I'm trying to get a sense of how far you think you've gotten relative to the 2017 period.
We've come a very long way. Our products, in terms of modernization, in terms of our objective of being an end-to-end hospitality software solutions provider, all the products end-to-end being modern, which means cloud native, of the same code base being able to support both the cloud and on-premise, because there are still many customers here who want to be on-premise for good reasons. So we couldn't spend more in R&D to support that. So the same code base supports both. So if you want to go on-premise today and then move to cloud tomorrow, you could do that, right? There is no issue with that. So creating all of that, we are about in the 9th inning, right? Most of the products are already done and even implemented in the field. And some products have weeks and months worth of work, which are also getting to the field. So in terms of achieving our product objectives, we are in the 9th inning. And while doing that, we also fixed ourselves financially. And we did all this without increasing R&D expenditure too much. So if you really analyze our R&D numbers, the numbers didn't go up as much, right? When you compare FY18 to now, only went up by like 7-8 million or so at best, while we tripled our R&D strength. So we've really done a lot without hurting the company financially, while keeping R&D as a percentage of revenue still stable. The product objectives have been achieved, and now we are in the process of moving to more a sales and marketing driven company.
And now that you have the platform from which to grow, I'm interested in digging in on the organic growth opportunity that you have in front of you. So the company was seeing some pretty nice growth pre-COVID. Obviously, the last 2 years have been somewhat challenging for your customers. Maybe walk us through, you talked about the TAM, but maybe talk about the size of the opportunity, and maybe talk a little bit about like what solutions you're displacing when you're signing up new customers.
Yeah, so the opportunity is huge. Like when you look at our recurring revenue, if you take the last quarter results and multiply it by 4, our recurring revenue annual ARR just crossed the $100 million annual run rate. Exit run rate of Q3 is more than 100 million. So you think of us as a 100 million ARR company. The market potential is 3 to 5 billion, depending on which numbers you believe. And we don't spend too much time analyzing it because we know it is huge. All right. We have a couple of huge competitors who are many times bigger than us. So the opportunity is clearly there. Now, as far as COVID is concerned, in certain industries, and luckily for us, the two industries in which we are the strongest, gaming, casinos, and complex multi-amenity resorts, which are the ones doing very well, and they are the ones who have the greatest demand for modern technology. Now, this industry has not been particularly greatly served, I would say, by its vendors. There's not been enough R&D investment. There has not been enough product innovation. There are just too many peers who just stay in to just take the recurring revenue as long as they can, not investing in the product, not moving it forward and all that. So all that has created big opportunities for us. Now, in the two industries that are doing well during COVID, our product innovation has created an enhanced requirement, need for these products. So, for example, contactless. Right, your guests, if you are running a hotel or a resort, your guests are now more and more used to modern technology. So they want everything on their phone, and they want everything contactless. They want everything integrated. When they come to the hotel reception, they want you to know that I have a spa appointment at 2:00. And when I'm at the restaurant for lunch, you need to know I have a golf appointment coming up at 1:30. So the whole thing has to be connected with modern technology and in your hands on your phone. So the guest demands are increasing. And along with that, you can no longer create guest experience just with people. Initially, a lot of the philosophy used to be that you create great guest experience by how well your people serve the guests. But now with COVID, you want distancing, and you want more to be served by technology as much as you want to be served by people. So all that has actually created an extra need, and we were lucky in the sense we were investing in all this even before COVID, because this is where the industry was going. So we were already investing in all that. Now, the way I would answer the question, Ben, is in the two industries that are healthy and also happens to be our strongest, where 70% of our business is that, the industries that are doing well, COVID actually sped up. It actually increased the pace of the requirement. Now, in other industries, though, like managed food service providers, Asia as a region, EMEA as a region, hotel chains where business travel still hasn't come back, the fundamental business environment hasn't been great. So that demand has struggled because of COVID. In spite of our products being a lot superior now, their business fundamentally hasn't done much better. So it has not been great. But in the two industries where we are very strong, it has actually sped up the need for these products. So it's been a combination of those two things.
Compounders is brought to you in partnership with Tegus. We created Compounders to uncover the lessons and frameworks of the best capital compounders in the world. And if you are a professional investor, VC, or operator, and you appreciate the deep research into the businesses explored on this podcast, check out tegus.co/compounders. With Tegus, you can learn about any company directly from former execs, current customers, and industry experts, all of which are in position to offer unique insights into a company's growth, its customer value, and its competition. What makes Tegus different is that you don't have to lead your own expert calls. The platform offers instant access to the world's largest collection of investor-led call transcripts on companies such as Compounders Guests, Viasat, Element Solutions, and Avid Technology. All you have to do is log in and you'll get instant access to nearly 25,000 expert call transcripts. And the best part, the Tegus collection grows larger with each investor and company that joins. Still want to do your own expert calls? Tegus is the right solution. Experts that are just as good or better than what you'd find on other networks, but starting at just $300 per call, not the $1,000 or more others charge. If you're ready to go deeper on the next compounding business, head to tegus.co/compounders for a free trial. I can personally say that having access to the Tegus platform and Rolodex of experts has fundamentally changed the quality of due diligence Coast Street does on both new and existing ideas. And I think you mentioned that your vendors have not served your customers particularly well in the past. I mean, is that this industry seems to have been a laggard in terms of updating its technology and becoming, like very technologically forward. Was that due to a lack of solutions or some kind of lack of demand from the customers as well?
It's hard. Therefore, they probably haven't done it. So what happened in this industry was a couple of big players who do a lot of things and also do hospitality sort of dominated the industry. They did extremely well like 10, 15 years ago when companies like Agilysys were not investing enough in R&D and not innovating enough. So 2, 3, 4, 5 of those players really dominated it. And it is not easy, right? B2B enterprise software is not easy when you're vertically focused. See, B2C is one thing. You create a product and 100 million people want it. It solves all ills. And when you are in a horizontal B2B, when there are millions of businesses or hundreds of thousands of businesses want your product, there is scale. You can sort that out. But B2B enterprise software, when you're more vertically focused, when you're only hospitality focused, the scale is not that easy to create, right? So it has to be a combination of handling the short term and the long term. It has to be a combination of short-term customer centricity and long-term product vision. It's not easy handling that, right? But that I so happen all my career, I've been in these kinds of businesses. It's not easy to do that. So many people were just not interested in putting that kind of investment into that. And a lot of the venture capitalists and all those kinds of investment tend to go to the lower end of the market. We are in the complex enterprise software sale. They tend to go to the lower end of the market. That's how they tend to go. And also end-to-end, that is starting from a booking engine all the way to property management systems, point of sale, service optimization, check-in, check-out, mobile, spa, golf, sales and catering. Many vendors are just not interested in doing it end-to-end. They just advertise their API in architecture, which we also have. We have the dual advantage. We provide the API architecture in case you choose a competing product to connect with, no problem. But we also provide you end-to-end integration. That kind of investment and interest, not many people have. And the VCs were picking off the lower end of the market or maybe one additional module, 2 additional modules. The barrier to entry to what we are doing now, the complex enterprise software sale, is not an easy thing to do. So people just took the lower hanging fruits.
So you mentioned having scale in your response there, and it brings up an interesting point about kind of focusing on a vertical versus kind of going horizontal. So I'm interested, I mean, are you head down casinos, resorts, hospitalities, and that is our world, it's a huge TAM, or are there, some other industries, retail, restaurants, at some point in this company's trajectory that could benefit from your software solutions?
Yeah, at some point, yes, Ben. Currently, no. So hospitality is a huge space. Even though you're vertically focused, like I told you earlier, it's in the billions. Our total addressable market, just in terms of recurring revenue alone, is in the billions. So just in the verticals that we are focused in, gaming casinos, the hospitality part of game, the non-gaming part of gaming casinos, resorts, hotel chains, managed food service providers, and we have not even scratched the surface in international regions so far. We have enormous growth potential. So that is our focus. And we can be enormously successful with that progress, both with revenue growth and profitability. But in order to do that, we first had to create a foundation of solid modern technology base, which is what took us 5 years to do or 4 years to do. We have been successful doing that, and it has been enormously successful so far, which we can see from our win-loss ratio. Now all we need is at bat. Once customers see demos, we are very successful because every answer is yes. You want to go to the cloud? Yes. You want to be on-premise? Yes. You want end-to-end solutions? Yes. You want only POS? Yes. All the answers are yes, and not many vendors can do that. So we have enormous potential. We've just laid the foundation, I would say. All the products, our demos are now 100% modern technology, only for the last 6 months or so. So we first want to settle in with that foundation. Now, once you settle in that foundation, if you are doing this interview to me, say 1 year from now or 18 months from now, there are opportunities for market expansion. Because the products are modern technology, they are easily enhanceable and extendable. Now it is a matter of mastering some integrations. some time management integration, some labor management integration, a third-party food delivery integration. So the few integrations like that, if we master, we can start expanding our market. But there's no need for that now. We've just done the first product steps. We now want to increase sales and marketing. We want to grow in this, what we are doing now. About 12 to 24 months from now, the opportunities will be there to add an integration here, a module here, and start moving into our neighboring markets as well, but within the range of hospitality.
And you've mentioned the competition a couple of times. I'm interested in the competitive landscape and how it's changed. And then maybe talk a little bit about how you think your products and the money that you put into, the R&D money you put into these products, how you've made them differentiated.
Yeah. So the competitive landscape hasn't changed much, I would say. Here and there, yes, but not much. Our competitive positioning in the US is very strong, right? And I will tell you why when I answer the second part of the question. We still have to establish ourselves in Asia and EMEA. And it has been a product-driven problem there as well. The reason why we have not focused much on international regions so far is we had to fix the product first. And for example, I'll give you one small example, like our point of sale solution that runs on the terminal that you see in restaurants when you go to a resort, so far could only support a Windows terminal, right? It only ran on a Windows terminal. Now, you know, Asia and Europe have different preferences, a majority of the part. One prefers Android, one prefers iOS. And the Windows terminal only goes so far when you come to handheld, kind of functionality. So it took us 2 years to completely modernize the terminal. Today, our POS terminal is not only the best POS in the market in terms of conversational ordering, in terms of being able to place your food order a lot easier, in terms of being able to say, well, I want the same hamburger as this, but just don't put lettuce in mine, kind of minor things. Operationally, it is the best POS, but in addition, the same code base supports Windows, iOS, and Android. That's a big deal. And so what that means is that terminal that runs when you enter the restaurant at the front desk is the same software that a waiter can carry around in an iPad or in an Android tablet or on your phone to take the orders or to go process the check. It's the same software that runs. We don't go to a third-party vendor and say connect it to our system. It's the same software. So when you do an enhancement here, it reflects here as well. So now we have the product to go after Asia and Europe. Right now we have the product sets that are also easily internationalizable or localizable. If you want to create a Spanish system with all Spanish language, you don't need to go touch the software. You just take the database with all the literals and translate it to any language you need. So all that has been created now. So international region, we have enormous opportunities to grow as well. Now coming back to the competitive positioning, in the US, we are well positioned because all modern technology, which not many vendors can claim, and also end-to-end. Our biggest competitors provide the core products and then tell you, we are giving you APIs, you go figure out the additional modules yourself and go integrate with them. While we provide end-to-end as well, and we also provide the API architecture in case the customer wants to choose another competing product for one of the modules. So what we are finding is our deal size is going up, and we have a real competitive advantage in the US because we are an end-to-end provider. It saves a lot of headaches for customers having to integrate. Internationally, our competition is quite stiff there because we have not established ourselves well enough. Like we have pretty formidable competitors in APAC. And in Europe, there are a lot of good technology vendors who are local. We are just in the process of establishing ourselves there and improving our competitive positioning by better sales and marketing.
So I definitely want to dig into that a little more. So, I mean, I think if I look at your revenue as of the last 10K, about 10% of your revenue was outside the US. So I'm interested in, I think there's this idea, especially in the technology engineering space, where if you have the best product, it wins, but you need sales and distribution and partners and all that stuff. So maybe talk a little bit about that strategy of now that you have the product, what are you doing on the ground to grow it outside the US?
Both in the US and outside the US, Ben, we have both the challenges. So we have so far, since we have spent so much on R&D, we have not done justice to sales and marketing. So the R&D investments we have done now, as we have said publicly, has a lot of operating leverage. We don't need to increase our R&D resources from where they are today for the next many tens of millions of revenue growth. We don't need to increase that. There will be some cost increases with merit increases and incentive bonus increases and all that. But the number of resources, we don't need to increase much in R&D because we sort of pre-did it, if you know what I mean. We invested first in R&D. So now as our revenue increases and our margins increase, a lot of the investment of that is going to go into sales and marketing, along with customer-facing services support and those areas, but mostly into sales and marketing. Now it is a matter of increasing the coverage, putting more feet on the ground, increasing our marketing presence. In fact, our lack of marketing presence affects us not only with revenue growth, it even affects us with investors like you, right? Many people just don't know about us because we have not gone to the top of the mountain and told everyone this is what we are doing. So that marketing sales investment we need, not only internationally, we need it in the US as well. And that's where our current focus is. We are increasing our sales presence. We are just about close to hiring a head of marketing now that we are just closing in now. We're going to expand our marketing department and our digital marketing presence and everything else, because now we feel confident that if you go recommend a customer to us, and all we need to do is for them to see the product demo and listen to our reference customers, and we'll be in good shape. So sales and marketing increase is going to happen in the US and for international regions as well.
And I think this is a good time to talk a little bit about margins and profitability and investing for growth, because you're shifting from more of an R&D focus to a sales and marketing focus. So I'm interested in your philosophy and how you think about balancing that desire to grow with the needs of the business to, and investing in the business, especially now as you're more moving into sales and marketing, versus, maybe investors' desire, or you're just in general innate desire to generate higher, operating and EBITDA margins over time. How are you balancing that?
Yeah. So our results so far, other than this fiscal year, FY22, the 3 quarters, have not reflected our philosophy of being a disciplined growth company. All the success I've had in enterprise software, I grew up under mentors who taught me well, who taught me that you don't need to sacrifice one for the other, right? It is possible to grow a company profitably, right? You don't need to go bonkers with investing and affecting your profitability. Now, we had to invest more in R&D. It was a matter of survival. Without the products becoming modern, there was no company, right? There was no question of company. Now that we are past that phase, we are back to our disciplined growth selves. So you should expect us to grow in a disciplined manner. Now, our previous results have not reflected that. And I'll give you a few things to just keep in mind as you look at our results. It's all going to get corrected itself soon. The trailing 12 months, once last year's Q4 goes away, the trailing 12 months results and all are going to be fine. But 3 things to keep in mind. 1, our fiscal year is April through March. So when I talk about Q4, please remember it's January through March. It's not October to December. April through March is what we do, Q1 to Q4. What we were doing before is we were capitalizing R&D costs because we were investing in R&D, and we were going to sell it years later, right? So there was a reason to capitalize costs. So as of FY19, which is like April 19 through June 19, calendar 19 timeframe, we stopped R&D capitalization. So we no longer capitalize R&D, right? Because now we are in agile development and agile deployment. So we develop something, we expect to make money with it 3 months later, right? So there is no need to capitalize and then amortize later. So when you look at our results before, like FY19, you will see our R&D cost was about 28 million. It was actually more or less like 39 million or so, because there were 10.5 million of capitalized R&D costs that you don't see in that gap number when you look at it. And then what happened when the pandemic hit, which was Q4 FY20, we could no longer justify what was in the balance sheet with discounted cash flow analysis of future earnings and all that. So we had to take a big impairment. So that affected Q4 FY20 results. Q4 FY21 results were affected by a one-time share-based compensation event that I can explain to you if necessary. So that was again a one-time event that won't happen again. So when you look at our last 3 quarters results of FY22, you will see us becoming a GAAP EPS positive company, a positive operating income company, you should expect that of us in the future as well, right? So now we'll be a disciplined growth company, and we have enormous revenue growth potential. So from that revenue growth and gross margin that we gain, we will be disciplined about how we spend more, including in sales and marketing. So essentially, our DNA is we are a disciplined growth company.
And when I look at your numbers, I mean, this company looks like it starts with about a 65% gross margin, at least on trailing basis. I'm interested, and I'm certainly not asking for guidance, but I'm just trying to get a sense of, like, for value investors who have trouble getting their arms around companies that don't necessarily generate or haven't traditionally generated operating profits. I'm just trying to get a sense of, like, what do you think, you know, in whatever you call like a mature state, this kind of margins, whether on gross or operating margins, do you think this business could generate over time?
Yeah, it'll be increasing over time is a short answer to that. So currently, like if you're a value investor and you look at our results, unfortunately, I'm not blaming anyone. It is just our own fault that you look at trailing 12 months, and that's affected by the last year Q4 results. So once we do this Q4, January through March that we are working through now, once that results comes through, I'm not trying to guide to anything and all that. The good news is the whole Q4 gets flushed out of the trailing 12 months results. But when you're a value investor and you're asking yourself the question, you have a gross margin of around 64-65%, will you be profitable? You should look at the last 3 quarter results. Or if you stay patient for a few more months, after that, the trailing 12 months should be fine. So the way I would think about Agilysys is that don't judge us on the past. We've had challenges in the past, accept that. I mean, it's not anybody's fault. It's just the way this turnaround was not an easy turnaround. But once we announce this quarter results, and then you look at FY22, which we will be finishing now, we are in the Q4 now, and use that as a base going forward. So you will, hereafter the results are quote unquote clean, easy to understand. It's simple. There's no one-time event or anything like that. We will remain disciplined about that. So you take the last 3 quarter results, you will see it's 3 consecutive quarters of positive operating, net income, not great levels, but definitely positive. And then once you flush out the last Q4, trailing 12 months results become better. And that becomes a good base for you to judge the future. So FY23 results will be a simple comparison with FY22. We don't need to compare it with 2 years before and all that like we had to do with COVID. It becomes simpler to understand the business. The numbers become very simple and clean to follow. And you should see that we fit in with your philosophy of being a value investor.
That should be really helpful for investors to understand going forward. I want to dig in a little bit into the cloud native SaaS move that you've made. I mean, obviously you made that decision a few years ago, and clearly, given where the world's gone, that's been a good decision. But I mean, I think there's this ideal of like how you roll it out and all a bunch of bells and whistles go off and there's this magic moment, but you have to balance between on-prem and off-prem. You have to balance different customers and their needs. So I'm just trying to get a sense, like, talk a little bit about any challenges that you've had, rolling out a SaaS product, especially when you have to maintain older versions of the same product, maybe for other uses.
Yeah. So not too difficult is my short answer, right? And I will work backwards with my answer. So please understand, Ben, we are in application software. This is not rocket science, right? We are not sending people to Mars and Moon and all that. This is simple, straightforward application software that runs hotels. And I won't give ourselves too much credit that we are dealing with, too many complex things. So, and with modern technology availability today, with all the talents and skill sets that are available, right, in the US, in India, and in other countries as well, creating a product that works of the same code base, both on-premise and cloud SaaS, is not too difficult. The technology is available to do that. And most of our products are based on one framework, one technology stack that makes it simpler for us, so that all the resources we hire are interchangeable across products. And the technology is there, to be used. We just have the advantage compared to our competitors that we did it in the last 3-4 years, right? So even though you could consider that a heavy lift, it's an advantage because we had access to the most modern technology possible. So building a product that is both on-prem and SaaS is not too difficult, and we have been successful with it because a lot of the modern products have already been installed both on-premise and SaaS, and it's working well. And it's the same code base. So if an on-premise customer decides to move to cloud 2 years from now, Their users don't have to be retrained. They won't even know from a data center to an Azure cloud. You don't even know that it happens. So that part is not too difficult, and it's worked out quite well so far. Now, moving backwards, yes, we have to support the old versions as well and the new version. And other than discipline growth, the other aspect of our DNA is we are very customer centric. Customer well-being matters to us. So it is not a matter of just driving our vision forward. You can't leave customers behind. These are not customers who are paid $700 for a phone and now the next version comes up. Oh, great, I'll go buy a new version. They spend hundreds of thousands of dollars and millions because we are in the complex enterprise software business. We just can't abandon the products. We have to support the old products as well. And we happily do that because we want to make the new cloud products attractive to customers so that they will, like a magnetic effect, pull into that. But we will not force them into that because customers' well-being matters to us. So what do? You reduce, you make your R&D more cost effective. Because we have to support both the old and the new, you require more engineers than you typically think we need. Therefore, we have to manage that cost effectively by a good combination of US and India, and we are doing fine with that. If you work well with your customers with your old products, they will move to your new products. But you can't abandon them with the old products and expect them to choose your new products. They will go choose a competitor's products. So yes, supporting the old and the new is a burden, it is a cost burden we carry, but it is not too much. It is the right thing to do. That is how you build business. But the modern technology products, being both on-premise and cloud, is not too much of a burden. That doesn't add to R&D costs or anything like that. That's fairly reasonable to manage these days in today's modern technology.
Can you talk about being customer-centric? I'm interested in how that played out as the COVID outbreak expanded and your customers were uniquely impacted. How did your software solutions help your customers through that period of time? And do you think you've built up goodwill with a lot of customers that will last a long time because of that?
Yeah. So again, working backwards from your question, as soon as COVID hit, even though we ourselves were in quote unquote trouble that time because we are entirely hospitality focused, we did the right thing for the customers. A lot of our recurring revenue is license based. It is not transaction based. Very little of our recurring revenue, very small amount, is transaction based. So for all practical purposes, we are license based. So even though we were not transaction based, we gave one-time credits to customers. It was flat out the right thing to do, regardless of how much trouble we were in, regardless of whether it was going to get us goodwill or not. As a company that is customer centric, that will always do the right thing, that was the right thing to do. So we did it, with full heart. We did it for a lot of our customers. It affected our results temporarily, but yes, we gained goodwill. But you never gain goodwill by one event, Ben. You have to keep up consistent customer service. It has to come from the heart. You really have to ask how high when a customer says jump up. And in our vertically focused business, every customer not only knows your name, they know your cell number, right? So these are close relationship kind of businesses, right? This is not B2C. So that gained goodwill, but we have maintained that goodwill by continuous good customer service. Now, how did COVID affect us? It affected us positively in some cases. So what we also did, along with that one-time credit, we gave free services to install a remote ordering tool called On Demand, and we gave it free for a few months. See, what we were lucky with when COVID hit was these contactless solutions, these remote ordering solutions, this check-in, check-out using your mobile, your ability to open a door using just your mobile phone. A lot of those products were already in development. They were all nice to have for customers, and they suddenly became must have, right? They had to have those products. So one of those products, we gave free services and free, and hundreds of properties took that up. That also gained some goodwill. And COVID accelerated the need for the additional modules that we had created. The core product suffered. The sales suffered because nobody was doing any major lifting and replacing core systems. But the demand for the additional modules really increased because they were all must-have products now. Especially the increase in gaming and resorts, which were doing quite well even from the middle of 2020. So that demand kept going. And the rest of the industries want the products, but their business environment has to improve. So COVID accelerated our position as a modern technology vendor.
And now that you have that, I mean, we talked about sales and marketing and investing in that. I mean, what is a process of, approaching new customers? Is there a system that they have to replace that's going to take a lot of time? And I'm just trying to get a sense of like what the new sales cycle looks like, how that's been impacted by, all of the COVID issues about, meeting people and stuff like that. And what, as the world loosens up, what is the opportunity for you to go in and pitch, people who are using other vendors to upgrade to your and to switch to your software?
Yeah. So in terms of the methodology, the sales methodology or the sales mechanism, it's not changed much for us. Customers who want to meet us in person, we meet them in person. Like I had to travel to meet customers because many customers know me in person even before my first vaccination. I just had to go because the customer said, "No, Ramesh, you need to be here. You need to see this." So I went. It was a risk to take, but that's a risk I had to take. And that's normally our attitude in business. If a customer wants to see us in person, we are in person. But we are able to do a lot of things remote these days, right? With the technology, with Teams and Zoom and all that. It's very effective to do that. And we do whatever the customer wants. And it just so happens that it's a good combination, right? Many meetings in person, many meetings through the technology available today. Both ways, it's working out quite fine. It's quite well. So the sales methodology, we're just comfortable with how it is going. It is effective. It is working. Sometimes you have to travel a lot. Sometimes you don't have to travel a lot. That works fine. Now, remember, we are in the enterprise software space, right? So we are more in the complex install, multi-product install kind of space. So it is not easy for a customer to forklift what they are doing now and replace it there. But what has worked out well for us is that they need one or two of these solutions because of the changing world. Because it is now becoming contactless. Now you just can't solve all your problems through people. You need technology. And there is a shortage of staff as well. So now you need technology solutions to increase guest experience, both the quality of the experience and the number of touch points, right? Everywhere you need to know who the guest is, what the guest preference is. This guest is left-handed. This guest is a vegetarian. This guest has a nut allergy, right? You need to know all that a lot more these days than before. So what happens is a customer has one or two or three of these needs. Fortunately, now when we do a demo, we do a guest journey demo, both on the F&B POS side and on the hotel management, property management system side. They come looking for one or two products and then they are stunned because we haven't done enough marketing, our own problem, by the breadth of the solutions available. So we carry a guest through the journey from the direct channel booking engine all the way through, and now they end up buying 6 or 7 products. So ultimately, though, it is a matter of product strength. And COVID, not only COVID, today's technology world is creating a lot of opportunities for us. And our deal size has dramatically increased.
I want to turn a little bit to capital allocation because we haven't talked about that yet. This company had not been particularly acquisitive since you arrived. Obviously, you were fixing your internal product set. So I'm interested in why you thought this was the right time to make the acquisition of Resort Suite and maybe talk about how capital allocation framework has changed within that.
Yeah, initially 2017, 2018, and even to a certain extent 2019, we were fixing our own house. Right? We are not you cannot use inorganic growth as a crutch. I'm a strong believer that if you're not good at organic growth, you probably will not be good at inorganic growth as well. If I can't manage my house well, I shouldn't claim that I can go manage my neighbor's house well, right? So we had work to do. We had to get our products to modern technology. We had to become a cloud SaaS company that we are today. We were focused on that, and our doors were almost closed. 2017, 2018, sorry, neighbor, don't tap on our door. We are just fixing our house internally. 2019, we opened up a little bit. We looked at a few opportunities. 2020, of course, COVID happened. And then we started opening up again in 2021. And we missed a few acquisition opportunities because we are a disciplined buyer, right? So we don't get it because we are a pretty good technology company, very solid R&D setup, and our build costs are not too high. Therefore, we don't get too aggressive with buy. So the fact that our build costs are managed and disciplined makes sure our buy costs don't go out of control. We don't get enamored and all hyped up about something that we see. For example, 17 new software modules I mentioned to you. If we had decided to acquire each one of them, I don't know, 600 million, 700 million, a billion, how much that would have cost us. But today, when a buy thing looks very attractive, our R&D team says, we can get it for you in 9 months. So we are disciplined about that, right? And we remain disciplined. We are looking at opportunities. We are a disciplined company. And when good opportunity comes, when the strategic fit and affordability meet, the two roads meet, we will absolutely be open towards that. Now, Resort Suite was a perfect fit. From the time I made the call, they have 150 customers. The CEO down was a perfect culture fit. Their strength area is in resorts as well as we are. They are only on premise with most of their products. So their 150 customers, many big names, now have the opportunity to move to cloud solutions as well. So it's a revenue synergy opportunity. It was just a perfect fit. It was right in our revenue or profitability multiple range. It was a perfect fit. We really liked the people. They liked us. So, it happened in about 6 months, pretty quickly. Those kinds of acquisitions, if it comes, we will be open-minded, but we are not, inorganic growth is not going to be a crutch for us. We are focused on organic growth. And if some inorganic growth opportunities come along, a technology that we need. See, now that you have products across a resort, we get a lot of data. We manage a lot of data of customers. So artificial intelligence, machine learning, that kind of taking us to the next level possibilities are there. So if a startup company, Silicon Valley, an opportunity is there, we look at it. We are end-to-end hospitality, but there are a few product gaps that we have. So if that comes along at a reasonable price, we'll look at it, but we'll remain disciplined, right? We don't need it. If it comes along, good price and a solid fit like Resort Suite, we will definitely look at it.
And I know you're focused on you're going to be focused more on international. Is M&A a way to accelerate the international opportunity, or would you much rather build rather than buy outside the US?
Yeah. So from a product standpoint, we are not building anything specific for international. We are building our products in such a way that the same code base supports on-prem, cloud SaaS, and also supports US and international requirements. We don't build a special French system. The system is easily translatable to French, right? So it is not a build or buy equation there. But if an opportunity like Resort Suite comes along internationally, and we feel they come with the customer base who are all eager to move to the cloud, and the cloud solutions are already there with us, we'll absolutely look at it. But product-wise, it's common products across the globe. R&D costs are optimized to create one product or one set of products that work across the globe. That is not a build or buy issue. But if a market share building opportunity, a roll-up opportunity comes up internationally, we'll absolutely look at it.
And this is a space, the SaaS software space, that has just been, very attractive to both strategic and private equity acquirers. I'm interested in how, you think of that as you are building your company, and how you think about, this is what, our company could potentially be worth in the private market versus this is our plan and this is what I think we can do. How do you balance that as a CEO, given, just all the hype and the love of this space within the private equity world, especially?
Yeah, we're generally not a very hype-oriented company, Ben. We are pretty simple people trying to build a good organization for the long term, right? That's how we think. And we are not, this is not a build to sell kind of thought process. This is a build a great company for the medium term, long term, care about the short term and the long term, focus on your employees, nurture talent, hire great talent, focus on your customers, and the shareholders typically get taken care of quite well, right? If you take care of employees, customers, product, and processes, everything else follows. So we are building towards becoming a great company. We have done the first phase of the work. We have done the hard part of the work, and now you will see progress, right? People underestimate the pace of innovation that is going to happen now, because 40% of our big R&D team was involved in modernizing products. Now you will see them actually taking the ball and running north and south, right? So now you will see the pace of innovation. And the reason why we don't even think about this private equity and all that now, because the gap is too large between a control premium kind of discussion versus what we see as the potential medium term. Next 2, 3, 4 years, what we see as the potential, now that we have done the hard work, that gap is too much, right? Why should you believe when I tell you what our potential is? You have no reason to believe me. And we have no interest in the control premium now because it doesn't reflect our future potential. So that bridge cannot be crossed today, right? So we are putting our heads down, building a great company for the medium long term, and we'll see where life takes us. Right?
And within that, and in a number of your other responses, you talked a lot about people, and that's something that's near and dear to our heart because I think a lot of investors don't focus enough on that. So you came into the company, and obviously there had been some struggles. So I'm interested in how you would describe the culture of the company, and maybe talk a little bit about how it's evolved. Especially as things have started to get better versus kind of that tough period in 2017.
Yeah. So as a CEO, Ben, I always want to be careful answering the question culture, because almost every CEO believes that the previous culture was bad and the current culture is great under me. And then the next CEO comes after me will say that culture was bad and I'm building a great culture, right? So I hear too much of that. So I want to be careful, right, with how I answer the question. So basically, these are the changes that have happened in the company from a people standpoint and how we manage. This is now a much better balance of vision and execution. Vision strategy is all great, but it's not of much value if you don't execute well. So I would say we are now a lot more conscious of the fact we are only as good as the walk, not so much about the talk. Right? I can go make a speech about our vision 3 years from now, but it is a matter of how you execute there. I think the current culture is we understand that balance well. I would say the current culture also is probably a lot more customer centric. Today's customer issue matters to us as much as what we are going to provide the customer, take them to the cloud 6 months from now. If you cannot take care of today's issue they have with an old version they are in, I don't think we are capable of taking them to the cloud. So I think the company understands that a lot better now. I also think the company understands today that financial responsibility is important. Right? You just cannot, like it was in 2017, lose 15 million cash a year and saying you're building something great towards. So I think we understand that reality a lot better, right? So, and I think today's environment is also more transparent when you think about our board relationships and all that with each other, not just with the board, with each other. We are a lot more transparent. The employees I do a global town hall soon after my earnings call every quarter. They understand the numbers. They understand the challenges. We have a weekly process of understanding our ups and downs. So we are transparent. We don't hide bad news. We don't do everything great. We make mistakes every week and we correct. So they know that. So the transparency is better. It's more collaborative. We hold each other accountable. It's an open culture. Anybody can walk into my office and say, Ramesh, you're an idiot. That's not the way you do that. You're making a wrong call. But once we make a call, we follow. So I think those are all aspects that are much more balanced today and has improved over time.
And within that, you mentioned that the company's become more customer centric. I'm interested in how that's impacted, if at all, retention rates over time. And how do you think about making the software stickier as you roll out more modules?
Yeah, our customer retention rates are world-class, are extremely good. But before I answer that, let me clarify. We don't play games with our net retention rate numbers, right? We have a philosophy against that. A lot of software companies, the way they explain their net retention rate. So let's say you think of your recurring revenue as a bucket of water, right? Our bucket of water has about 100 million ARR. If you take the last quarter, 25.1 multiplied by 4, it's about 100 million, right? Let's call it 100 million to keep the math simple. So that's the amount of recurring revenue water we have in the bucket. The way we measure churn is how much water is leaking out. And a simple percentage measure. We have 100 million water in the bucket to start the year, let's say, or start a period. And we have lost this much water because of customers going away to a competitor. This divided by that is a percentage. So by definition, it cannot be more than 100. What we don't play games with is to say, but we are also adding water to it. Like if you looked at our last earnings results, new products sale to current customers is at a record level. And new sites where current customers move to new properties is doing very well. So if we add what water we add into the bucket, we can make our net retention rate look much more than 100. We can go to 120, 130, whatever percentage you want, we can go there. But we don't think that is the right way to express retention, which is 1 minus churn, right? Which is the reverse of churn. So that's one thing to keep in mind. Number two, what software companies are doing today is they are excluding site closures out of the churn number. oh, that site closed, it's not our fault. Sorry, we don't count it as a churn. We don't play that game. If the water is leaking, it is leaking for any reason. We count it as it's a lost annual recurring revenue. So by our simple math, when you count churn divided by recurring revenue run rate, we are well north of 95% customer retention rate, comfortably north of 95%, which is world class. If we do calculations like how other software companies do, it'll be well north of 100%, but we don't like to play that game.
And one of the signs of a great business and one with a moat is that it has pricing power. I know costs are rising everywhere. I'm sure your labor costs are going up. And I'm interested in your assessment of your own pricing power and how do you approach your customers about raising prices over time?
By producing better value, Ben, is the simple answer to the question. So far, it's not been a major topic for us inflation-wise. We've done fairly well in terms of managing our costs and all that. And we have always been the higher priced vendor. So we lose deals because of low price. There are competitors who are not spending enough on innovation, who are not improving their products, who just fight a price war. We don't get into that because this market is big enough for us to grow even if we lose a few deals. All right, it's enough to grow. And we are generally the higher priced vendor. That's why we are reasonable with our prices. We are fair with our prices, but we won't go below a certain point just to win a deal. There is no point winning a non-profitable deal. Because for us, customers stay with us for a very long time, very, very long time. It runs into decades, right? So we do not need to go win unprofitable customers when there are a lot of profitable customers there. So we are disciplined with our pricing. We are fair with our pricing. And we are innovating at a fast pace. We are providing end-to-end value. The customer saves a lot of integration costs. Instead of you going to 4 vendors, one a booking engine, one a property management system, one a remote ordering tool, one a quick pay solution to scan the QR code. Instead of doing that, when you go to one vendor, they come already tested end to back. And it also comes with an open API architecture in case you want to change your mind later. That's of value to them. So if you produce value, there is enough pricing in this market. So that's not a major concern. I don't wake up worried about pricing.
And I'm curious because you've been through a number of situations and turnarounds, and obviously you've done a lot of work so far at this company. What in terms of your own leadership skills, what do you think you've developed over the time that have allowed you to be so effective in such difficult situations?
Yeah, I mean, I don't know if I've been effective, but the team put together has been very effective, Ben. Most of the credit goes to them. And a lot of the people who work here, the current management team has been stable now for 4 years, or more than 4 years. And all our VPs and above, the average tenure here is 5 years or so. So we've been a team that is sort of stuck together, right? We like each other, we challenge each other. So it's been a collaborative environment. So it's worked out well. So as far as my own leadership style, I don't know, much to talk. I'm a little uncomfortable talking about myself all the time. It's all about the company. But I would say my leadership style hasn't changed much, Ben, over the years. I've always been sort of a hardworking guy, right? I've always been an attention to detail sort of guy. And I'm reasonably okay with enterprise software because I was a hands-on developer myself 10, 12 years. I've grown through the ranks. I've been through every position you can practically go through in enterprise software. So I have a fair, level of competence and all that. I understand the business quite well. And I'm more a detail-oriented guy. I'm a strong believer in that, right? I'm a hands-on sort of manager because my belief system is that as a leader, you make 2 kinds of decisions. You make data-supported decisions, analytics-supported decisions. Most people in this world are reasonable. Most people in this world are smart. So if you show them enough data and you make sure you have looked at all angles, you don't miss out on a piece of data, it leads to a good decision. I can convince a board, I can convince a management team because I have data to show, and most people are reasonable in this world. They reach the same conclusion. But a leader makes another kind of decision, which is instinctive, where you're short of time, where you have to make a quick call today. That's like a baseball batter. It's coming at you at 90 miles an hour, right? Or you're a quarterback. You have 2 seconds to decide between 3 wide receiver options you have. Those are instinctive decisions. You don't have the time. You have to carry people along with you. That comes with practice. That comes with hard work. That comes with understanding the details. So a detail I'm understanding today may not be of You may think, why is he spending time on that? But I spend time on that because I know somewhere in the future I have to make a quick call. The more I understand the details, I think the higher the probability of the decision being right. So I'm a hands-on sort of manager. Now, how has my leadership style changed? I would say I probably become more patient with age. I've learned to handle, board relationships and all a lot better. I've been through a couple of CEO stints, so I have a probably more mature relationship with the board. It's also increased my confidence level. When you are successful in a couple of things, you feel a little better that, okay, there's a high probability you will make the right decision. And probably the biggest change is I've become more patient. I've become a nicer competitor, if you will. I've always grown up as an ultra competitive guy, right? So I was a bit too much of a competitor. I've learned to be more of a cooperation guy, right? You have to work with your competitors as well. They also are doing a job. This industry could use multiple good vendors. So I've become a lot more broad-minded about competition. And with age, I guess all that comes.
And as a firm, we always like to focus on the key variables for each company. So I'm curious about what are 3 or 4 things you think this company absolutely has to get right for the stock to be a good investment for both employees and shareholders going forward?
So we have to get subscription revenue growth right. Overall, we have to get revenue growth right because we have done the hard work for that. Now there is no excuse, right? Now we need to get the growth equation right. Within that, you have to get the subscription revenue growth equation right because the products are there. And like we publicly announced in the last couple of 2-3 earnings calls, more than 90% of our customers' new properties are choosing to be in the cloud, are choosing SaaS solutions. So you have to grow subscription revenue. So that we absolutely have to get right. About 2/3 of our revenue today comes from POS, while PMS is more profitable. It's more pure software and all that. We have to get PMS right. All right, we just have to get property management system and all the additional modules around it right. And there are good signs for it. Our subscription sales in PMS has dramatically increased, right? In spite of many of our market verticals still struggling due to COVID, like Asia and all that. So we have to get PMS growth right. We have to get overall subscription revenue right. We have to get people talent right. We have to nurture the talent we have today. And we have to be a company that attracts top level talent from outside. Because now we are moving from being an old technology company to being a truly cloud company. Virtually 90% of the installs we do in calendar 2022 are all going to be sophisticated, higher technology, right? Well integrated. So that means there's a much bigger need for talent. So we need to be a company of a prestige that attracts the best talent in the industry. So those are all some of the equations we have to get right. We have to continue being customer centric, right? We have to do all the right things. Given our momentum, we have to make sure we don't get an acquisition wrong. That's the reverse of your question, right? Because that's one of the risks we have to make sure we handle carefully, right? So I think those are some of the top things that come to mind.
And when you're executing a difficult turnaround, and as you said, you were solving for a lot of variables, I'm sure there were some mistakes along the way. It's almost inevitable. I'm interested in any mistakes that you've made that you could highlight and what you think you learned from them, over the last, call it 5 years.
Yeah, so micro and macro answers, right? Let's just break it up. At a micro level, I'm a paranoid guy by nature who I think I make mistakes every day, right? And I'm sure at the end of this podcast, I'll be wondering, I should have answered that question better. And I didn't think of that. Why did I not think of that when he asked me that question? So I should have meetings that I don't handle well enough, or customer conversations and deal discounting decisions. I think series of mistakes. And all you can do in life, Ben, is to improve. Right? I'm a great believer that the only thing I need to be good at is improving. Right? So everything else can be taken care of. So I do make a lot of micro mistakes along the way that are just too many to list here. But at a macro level, right? You always look back at the 5 years and you think about the big decisions. Some of the people change decisions, I think, should have been faster, right? I think I was playing it a little bit too safe because I was trying to make sure I don't rock the boat while you move the boat forward, right? The boat had been stuck in mud for a while. I was a little bit too careful with that, maybe, that. And now looking back as to how successful our R&D efforts have been, I'm wondering if a better, more aggressive CEO than me would have doubled down on that better in 18, 19. right? Now that I see how successful it was, maybe a better CEO than me would have gotten it done a year and a half before by increasing the investments in R&D even more than I did, right? I think taking 230 people R&D to about 850 to 900 now was an aggressive step across years, but maybe I should have done it even faster so that the position we are in today, we would have been a year or so ago, right? And we made a couple of mistakes with share-based comp, which we did the right thing. It is really helping us with employee retention now. The great resignation and all that you read in the papers don't apply to us that much in the US. So we are not, with our senior staff, we're not having too many issues. We did the right thing, but we could have managed that better, right? That's another mistake that we learned from, that we will do better.
One of the reasons I was smiling when you're saying that is because you're probably the third or fourth CEO to say the exact same thing, that especially in a turnaround, you have to move fast. You have to be willing to move faster. And so it's interesting that how often that's come up throughout this podcast. This has been great. And I'm really curious about this last question and the one we always close with is, so what would you say is the most misunderstood or underappreciated aspect of this company or business?
Yeah, so I think a couple of things are misunderstood. By the way, it's not the perceiver's fault. It is our own fault, right? Our past results are sort of dragging down what our true state is today, right? So when you as an onlooker look at us, I think you're making a fair, assessment of where we are, but that's because of, how our past results are. So I think our current short-term, medium-term, long-term potential is being underestimated. Right, because you don't have a view of the window that we have, right? We know what is going on inside, and you're sort of judging us by what the past results are. So I think we are underestimated as to the current position we are in, right? The short-term, long-term potential is being underestimated. I think our pace of innovation about 6-9 months from now is being underestimated, because you don't see the power of our R&D, because our R&D is still to a certain extent involved in fixing the past, right? In modernizing the products, right? This is like a running back who's busy changing his shirt. He's not carrying the ball forward yet, but without changing the shirt, you can't run the ball forward, right? So we're caught in that phase now. So people are underestimating how much our pace of innovation is going to carry us forward in the next 6 to 9 months. The complexity of the business is underestimated, which means the barrier to entry is underestimated. The work we have done creating end-to-end about 30 software modules, about less than 10 of them core, about 17 of them additional modules, the end-to-end power that it gives the customer, what kind of competitive advantage that is, and how difficult it is to build. Like, even if our biggest competitor decides today that that's what we're going to do, it's not easy to do that. It's going to take them years to do that, right? So the barrier to entry and our competitive advantage positioning now is underestimated. And I think the difficulty of this business, building the right culture, being customer-centric, even if it slows down innovation, supporting the old and the new together is all not easy. The creating that sort of a mindset company is not easy. I think that's also underestimated.
Well, I'm really looking forward to see how this all plays out. I mean, you've done a lot of work, and it must feel great to be in a position to, finally roll it out to the world and finally have, the product set and ready to go. So good luck with all that. And thanks so much for all this time. It's been a great conversation.
Thank you, Ben. Thank you for the opportunity. I appreciate it very much. Thank you.
Thank you. That's it for our show today. We hope you enjoyed the conversation. We recognize that you have a lot of different podcast choices, and we appreciate you spending the time with us. We are continually working to make the show better, and we would love your feedback. The more candid and honest, the better. And if you have any suggestions for public company CEOs you would like to see on the podcast, please let us know. And of course, warm intros are always appreciated. Please feel free to email us at podcast@covestreetcapital.com with your comments or suggestions. Thanks again, and stay tuned for the next episode of Compounders, Anatomy of a Multibagger.